Assalamu alaikum. Foreign currency transactions and hedging foreign exchange risk will be explained in 4 parts. In the first part, we will explain the concept of foreign currency transactions and the problems with recording and reporting foreign currency transactions. We will explain the basic terminologies that we are going to use while dealing with foreign currency translations. We will explain the concept and distinction between the term measured and denominated. We will describe the meaning of foreign currency transaction, direct and indirect exchange rate. We will explain 3 stages of concern to accountants for foreign currency transactions and explain the steps used to translate foreign currency transactions for each stage. Next, we will solve an illustration on import and export transactions, and finally, we will do an exercise on import and export transactions. But in the beginning of this session, I would like to thank my son, Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories without which making these videos would not have been possible. I would like to thank Nabiya Khan for helping me out in preparing these awesome slides. I would like to thank my wife Samina for her care, encouragement and constant support, who allowed me to use time for her in making this video. So in this session, we are going to talk about accounting for foreign currency transactions. So let's have a look at foreign currency transaction and what does it entail. We start with the assumption, and the assumption is that we are based in Saudi Arabia. These Saudi firms like Aramco, Sabic, Al-Marai, Mahmoud Saeed, Saudi Cement Company, they operate overseas, having operations in USA, Germany, Japan, Indonesia, Australia, or they might be having investment in other countries. Such companies are engaged in international activities such as exporting or importing goods, establishing a foreign branch, or holding an equity investment in a foreign company. So let us explain this with an example. A Saudi firm buys goods and services from Germany. The German company wants to be paid in euros, to which the Saudi firm agrees. However, the Saudi firm will record its transactions in Saudi riyals. So transactions in a foreign currency must be translated into domestic currency. So the Saudi firm buying from a foreign company will have to pay in foreign currency, and if it is selling to a foreign company, it might be receiving in foreign currency. But the Saudi firm will report these foreign currency receivables or payables in Saudi riyal. The interesting fact is there will be variation in the exchange rates, because of which the Saudi firm may have gain or a loss. This video explains how the company may gain or lose because of variation in exchange rates. We will start with explaining the basic terminologies that we are going to use while dealing with foreign currency translations. The 2 basic terminologies are direct exchange rate and indirect exchange rate. Basically, they are the same, depending upon how the information is provided. Let us first talk about the direct exchange rate. It is how many Saudi riyals equal to 1 unit of foreign currency, like 4.89 Saudi riyal is equal to 1 British pound. It can also be said that a Saudi firm need 4.89 Saudi riyals to buy 1 pound of British currency. How much of your currency to buy 1 unit of another currency is what we mean by direct exchange rate. We need 4.89 Saudi riyals to buy 1 British pound. Currency can also be expressed in the indirect exchange rate. In case of indirect exchange rate, we need to divide 1 by the direct exchange rate. So we need 0.20449 British pounds to buy 1 Saudi riyal, or 1 Saudi riyal is equal to 0.20449 British pound. Other basic terminologies we need to know are spot rate, forward or future rate, and forward exchange contract. Spot rate is the exchange rate today, or it will be more appropriate to say this moment, as the rate changes constantly. Forward or future rate is the rate at which currencies can be exchanged at some future date. For example, the Saudi firm has to pay the German firm in euros after 30 days, and it do not want to wait till the date of payment, as the exchange rate of euro to Saudi riyal may go up. So the firm locks at an agreed rate today, and this rate is guaranteed for the date of payment. So in a forward exchange contract, we agree to exchange currencies on an agreed future date at a specified rate. Yet another terminology we need to know is floating rate. Let us talk about it in the next slide. The currency exchange rate always fluctuate. These fluctuations depend upon the supply of the currency, political risk or economic risk, etc. So there is always a risk to do business with a foreign company, as the domestic company may have to pay or receive the foreign currency. Let us take an example over here. The Saudi firm has a payable of 100,000 Japanese yen. Let us see what are the options. First, the Saudi firm can buy the yens at point 0 on the date of transaction. So if the Saudi firm buy the yens at time 0, they have to pay 2,900 riyals. If the Saudi firm don't buy the yens at time 0, rather it waits for the settlement date, the date the Saudi firm need to pay the Japanese company, and suppose the exchange rate on settlement date is 1 yen is equal to 0.0320 riyals. The Saudi firm is losing, as they will be paying 3,200 riyals in place of 2,900 because the exchange rate has increased. The exchange rate will work in favor of Saudi firm if the Japanese yen becomes cheaper on the settlement date. Suppose on the settlement date 1 yen is equal to 0.0250. The Saudi firm is gaining as they will be paying 2,500 in place of 2,900 because the exchange rate has decreased from 0.0290 to 0.0250. So these results will be just the opposite if the Saudi firm is selling and not buying from the Japanese company. But we should keep in mind that the Saudi firm is not in the business of foreign currency business. Rather, they are in the business of buying and selling their products. Let us now talk about two concepts that we must know before we deal with foreign exchange translation in the next slide. Translations are normally measured and recorded in terms of the currency in which the reporting entity prepares its financial statements. Just keep in mind that we are talking about Saudi firm. So the reporting currency is Saudi Riyal. When the Saudi firm enter into a transaction with a foreign company, they first negotiate the currency in which the transaction will be settled. If the transaction is to be settled in Saudi Riyal, there is not much risk. But if the settlement is in a foreign currency, then there will be lot of risk. If settled by a foreign currency, Saudi firm measures the receivables or payables in riyals. But the transaction is denominated in the foreign currency. The Saudi firm will not record in foreign currency, rather it will convert the foreign currency into Saudi Riyal before recording. So, foreign currency transaction requires payment or receipts in a foreign currency. A Saudi firm is exposed to risk of unfavorable changes in the exchange rate. The changes in exchange rate may be favorable or unfavorable, but the risk will be in case of unfavorable changes only. Let us see how does it work. If the direct exchange rate increases or the foreign currency strengthens, for example, 1 euro is equal to 4.06 Saudi riyals, and the Saudi firm has a payable of 100,000 euros. So right now it needs 406,000 today to make the payment. If the euro strengthens, suppose say 1 euro now is equal to 5.06 Saudi riyals, then it means more riyals are needed to buy euros. It means that Saudi firm now need 100,000 more to make the payment of same amount of euros. 5.06 times 100,000, that will give you 506,000. So we need an extra 100,000 Saudi riyals to make the payment. If the scenario reverses, that is 1 euro is equal to 3.06 Saudi riyals. Now the Saudi firm need fewer riyals, 100,000 riyals less. This means that the foreign currency has weakened and the Saudi riyal firm will gain. However, this relationship will be reversed if the Saudi firm will receive foreign currency in place of paying. The Saudi firm would like that the riyals weaken if it will be receiving the foreign currency. Next, we will talk about the dates we need to know to translate an account that is denominated in foreign currency. There are 3 dates and sometimes there may be 2 dates also. So first, in the transaction date, the date the transaction takes place. Second is the balance sheet date. It means if the transaction is not settled in the current year, at the date the transaction is measured and recorded in riyals by multiplying the units of foreign currency by the current direct exchange rate. At each balance sheet date that occurs between the transaction date and the settlement date, recorded balances that are denominated in a foreign currency are adjusted using the spot rate in effect at the balance sheet date, and the transaction gain or loss is recognized currently in earnings. At the settlement date, in the case of a foreign currency payable, the Saudi firm must convert Saudi riyals into foreign currency units to settle the account, whereas the foreign currency units received to settle a foreign currency receivable will be converted into riyals. Although translation is not required, a transaction gain or loss is recognized if the number of riyals paid or received upon conversion does not equal the carrying value of the related payable or receivable. Please keep in mind that gains and losses from foreign currency goes on the income statement and not on the balance sheet. Let us talk more about the foreign exchange risk with the help of an example. On December 1, 2010, a US firm purchases 100 units. They are purchasing from a French firm for 500,000 euros to be paid on March 1. The firm fiscal year end is December 31. Assume further that the US firm did not engage in any form of hedging activity. The spot rate for euros, $2 at the various times are given as we here. So the US firm would prepare the following journal entry on December 1. They are purchasing. So purchase is debit and accounts payable is credit, and they have 500,000 euros and the spot rate is 1.25. that gives us 625. And the T account will be, for purchase account we have 625 in the debit, for accounts payable it is in the credit. At the balance sheet date, the accounts payable denominated in foreign currency is adjusted using the exchange rate, that is the spot rate, in effect at the balance sheet date. So the entry will be, now on the balance sheet date the rate is 1.28, on the transaction date it was 1.25. So the company is the US company is making a loss. 1.28 minus 1.25 times 500,000 is 15,000. And the T account will be, we have a transaction loss on 31st of December, and there is a accounts payable, increase in our accounts payable for 15,000. So now the balance for all these accounts for the year 2010 is 625, 640 and 15. Now, before the settlement date, the US firm must buy euros in order to satisfy the liability. With a change in the exchange rate to 1.27, the firm must pay 1.27 500,000 635,000 on March 1st, 2011 to acquire 500,000 euros. So the general entry is, now we are going to buy, so cash is going to be credit by 635. We have to make the payment of 640,000. So we have 640 over here, and the difference is our transaction gain. Okay, so now we assume that the US firm don't buy but rather they sell, and all other facts remain the same as it is in this example. So our payable becomes receivable, our purchase becomes sales, and we are going to record accordingly. So we have receivables of 625 and we have sales of 625. Then on 31st December, when we were purchasing, we had a transaction loss, and now this becomes a transaction gain, and payable will be a receivable now. So receivable is debit and transaction gain is credit. So receivable is debit by 15,000 and transaction gain is credit by 15,000. Again, they are going to get the money. So account receivable is 640,000, and from this 640 they receive cash of 635, and there is a transaction loss over here of 5,000. So previously, if you can see that there was a transaction gain and now of 5,000, now we have a transaction loss. If you compare the two, the net effect of this spot rate is that we have a transaction loss of 15,000 and there is a gain of 5,000. So the company has a loss, is going to suffer a loss of 10,000 if we have all this information and the firm is purchasing. The decision or the result changes. Here we have a gain of 15,000 and the loss is of 5,000. So the company has gained because of variation in exchange rate. Let us now do an exercise. Now, during December of the current year, Teletext System Incorporation, a company based in Seattle, Washington, entered into the following transactions. December 10, sold 7 office computers to a company located in Colombia for 8,541 pesos On this date, the spot rate was 365 pesos per dollar. So Teletext Company, a US and not a Saudi firm, sold goods to Colombia firm. As a result, the Colombians are going to pay the US firm, but they will be paying in pesos and not in dollars, a foreign currency for the American firm. Each 365 pesos will buy 1 US dollar. So this is the indirect exchange rate. We can convert the indirect exchange rate to a direct exchange rate by dividing 1 by 365, and that will give us 0.0027. So we can say that each 0.0027 US dollar will buy 1 peso, 1 Colombian peso. Let us see how we are going to record these transactions. First, we have to record the transaction in US dollars. We have a receivable because we are selling, so the US firm is selling. So we will divide 8,541 by 365. So we get 23,400. So the journal entry is account receivable is debit and sales is credit by 23,400, and I have already made a T account for the accounts involved over here. The transaction was on December 10. So the amount is 23,400 for the receivable, and for the sales it is in the credit for 23,400. Then prepare the journal entry necessary to adjust the account as of December 31. So this was in the previous transaction, December 10. So now assume that on December 31st, the direct exchange rate was Colombia peso 0.00268. Now the peso has decreased, and it has before it was 0.0027, and now it is 0.00268. This means that the US dollars has strengthened, and this is bad for the US firm, because when it has a receivable and if US dollar is strengthening, the US firm will buy less of US dollars with pesos. You can see that on the transaction date, our receivables was 23,400. Which has reduced by 510 on the balance sheet date, and we will record this as a loss. So transaction loss is debit and accounts receivable is credit. So that's how we have recorded on the balance sheet date. Now let's talk about the settlement date. Assume that the direct exchange rate on the settlement date was Colombian peso 0.00320. Now on the transaction date, the rate was 0.0027. On the balance sheet date, the rate was 0.00268. Here the US dollars has strengthened. And on the settlement date, the rate is 0.00320. So now the US dollar has weakened. So the transaction date, the rate was 365 pesos for $1. On the balance sheet date, we can convert this if you want as an indirect exchange rate. So this will be on the balance sheet date, this will be 1 divided by 0.00268. This is equal to 373.13 pesos equal to $1. And on the settlement date, it is 1 divided by 0.0032, and that is equal to 312.5 pesos. The interesting thing to be observed is that the US firm will be happy if the US dollar weakens, because it has pesos that can buy more US dollars. So cash is going to be, so now we are settling this account. So we have cash is the pesos that we receive is 8,541. This is the rate on the settlement date. So we have 27,331. The account receivable was 22,890 on the balance sheet date. So we have 22,890, and the difference is our transaction gain. Now, during December of the current year, Teletext System Incorporation, a company based in Seattle, entered into the following transaction, and now they are purchasing computer chips from a Taiwanese company, and the contract was denominated in Taiwanese dollars and not US dollars. So the direct exchange rate on this date was 0.0391. Now, the Taiwanese firm wants the payment, you can see, in Taiwanese dollar and not in US dollars. So considering the spot rate of 0.0391, this is 0.0391 times 500,000, this will be equal to 19,550. So this is the direct exchange rate. The indirect exchange rate will be 1 upon 0.0391, that is equal to 25.58 Taiwanese dollars will be required to buy 1 US dollar. Now, on the transaction date, we record that payable by debiting purchases and crediting the accounts payable denominated in a foreign currency, and the amount is 19,550. So purchases, so 0.0391 is the rate, spot rate, multiplied by the total purchase price in the foreign currency, that is 19,550. And we record over here purchase, and we have accounts payable for 19,550 on 12th of December. Now, on December 31st, the direct exchange rate was 0.0351. On December 12th, Taiwan dollar was 0.0391. So we need less of US dollars. So again the US dollar becomes strong, and that is good for the US firm, because with a strong US dollar it needs less of the US dollars to pay Taiwanese dollar. So we pay $2,000 less, and that is a gain, and we would be paying 2,000 less on accounts payable. So now accounts payable is debit and transaction gain is credit. However, still we have to settle the account on the settlement date, and let us see how to do it in the next slide. On January 10th, the settlement date, the exchange rate was 0.0398. The exchange rate on the balance sheet date was 0.0351. So the US dollars has weakened now, and now Taiwanese dollar has become stronger by 0.0351. $0.0398 one Taiwanese dollar is equal to 0.0398 US dollars. So if we multiply, we are going to have 19,900. The accounts payable was 17,550 on the balance sheet date, and the difference is a transaction loss. So if you look into the net effect is that there is a transaction gain of 2,000 and there is a transaction loss of 2,350. So the net effect is a loss of 350. Remember that any foreign currency transaction gain or loss are included in net income, and we have two transaction approach. The sale or purchase is viewed as a transaction separate from the financing arrangement. Therefore, the dollar amount recorded in sales or purchase is determined by the exchange rate on the transaction date. Adjustment of the foreign currency denominated and receivable or payable recorded directly to the transaction gain or loss recorded the net income. So all in all, gains and losses goes into net income from foreign currency transaction. A receivable might go up or receivable might go down. A payable might go up or it may go down. The offsetting entry, either a gain or a loss on the foreign currency, and the gain or a loss is going to be recorded in a net income. Now this is emphasized because when we look at the translation of the financial statement, we have to know if it goes into the net income or OCI, that is other comprehensive income. We'll be talking more about this in the videos to follow. So this completes the first part of our explanation of translation of foreign affiliate financial statements. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much.